Look, Sydney and Melbourne are both rebounding from very low listing environments in the time frame when interest rates are increasing at a rapid rate, and vendors and buyers were both uncertain about the path ahead. We've seen that settle down. There's a lot more consensus view of where interest rates are, and a feeling that there isn't really a lot more growth to go, and there's more certainty as to where interest rates will be. That has resulted in Sydney and Melbourne listings rebounding. We've seen growth of high 20% year on year in both of those markets.
What trends have you detected in the other markets?
It's been a really interesting market at a national level because despite the growth in Sydney and Melbourne, national listing volumes are close to flat. That is driven by declines in Queensland and Western Australia. So there's a couple of trends that we're observing. Firstly, we're starting to see a return to the normal listing environments that we've seen pre-COVID, pre-Royal Commission, pre-interest rate rapid rise. Sydney and Melbourne lead the national property cycle, Queensland follows, and then other states follow that. So we're seeing Sydney lead the price and volume lift up, Melbourne follow, and WA and Queensland are coming off the bottom and starting to grow. The second trend we're seeing is the impact of economic activity, interest rates, cost of living pressures create polarisation. So at a premium level, property pricing is doing really, really well, and we're seeing strong growth, strong activity, strong action. When you start to move into lower medium price properties, zones, geographies, that mortgage pressure, the impact of inflation, the impact of high interest rates has seen lower levels of activity and a lower level of confidence. The third impact we're seeing is a flight towards apartments. Apartments are actually growing and seeing strong levels of interest versus housing. That's both a lack of supply. Supply into that sector has been constrained for a number of years. We've got immigration and high levels of people coming into the country putting pressure on that. We've got low levels of rental and low levels of vacancy rates that is pushing a lot of renters into the buyer market. And when you bring that all together, together with people who used to be sort of looking to invest in a house, maybe not being able to afford that with current interest rates, to start looking at apartments, you're seeing a lot of demand and a lack of supply in apartments, and that sector outperforming house price.
You've recorded greater revenue growth in commercial listings. What are your observations about valuations in this sector and whether owners of commercial estate are now marking down their assets?
Yeah, we've seen some interesting trends. A lot of the growth that we've achieved in our commercial real estate business has been through new product development, price increase. We haven't seen a lot of volume come back onto market. Now, industrial has always been a very strong market segment over the last couple of years, and that's fine. But we have seen office and retail come under pressure. Office because of vacancy rates and sort of a view and expectation about whether people will return to offices, and particularly in CBDs en masse. And retail, obviously concerns around general retail activity. So we haven't seen a huge lift in volumes, and volumes have been quite stable in those areas. A lot of the sort of lack of transactions, for example, in the commercial real estate, has been the gap between vendor expectations and purchaser interest. And we're starting to see that gap close, and you're starting to see an acceleration of transactions, but it still is nowhere near levels we would call being sort of an average market.
You've recorded an increase in listings overall, but you haven't matched the volume of your key competitor, REA. What are the challenges to gaining greater market share?
So from a market share perspective, there are many things that drive market share. One of them is listings coverage. How many listings do we have on our platform relative to the market, relative to our major competitor? There's also audience. That's the other side of our marketplace. How many people do we have coming to our platform to engage? And then those two factors together are what enables us to actually charge for our products. And we charge a price which then generates revenue. So market share is actually a really interesting combination of all three of those. And interestingly, we've seen growth and outperformance on two of the three metrics. So our audience share has increased. The size of our audience relative to our competitor has actually increased at a much faster rate in the last 6 months. On a pricing and yield basis, we've outperformed in the average revenue we're able to charge and sustain within market relative to our competitor, and that has meant that a lot of our customers are stepping forward and taking on more and more premium products. If I look at listings coverage, we have seen a slight decline in listings coverage relative to our competitor, but that has been part of a strategy that we've put in place where we've actually taken the chance to actually push through some of the highest price increases that we've seen on an annual basis. That has come at the at the expense of a small level of listings coverage decline, and we've seen that listings coverage decline actually improve over the back end of the last half and continue to improve in January and February. So, it's a small price to pay for what has been a really strong revenue performance overall. And these are the trade-offs we make as a management team. We've made a strategic bet at the beginning of the half, and it's actually paid off significantly, but we're balancing those three dynamics between audience, listings and revenue, and we're balancing that well at the moment.
And so will you be pursuing, and will you have gained market share by the end of financial year 24?
Our goal is to continue to deliver on our marketplace strategy, to continue to grow the business. There is significant opportunity ahead. We are operating in an environment with very low listings overall in our residential business. Listings are still subdued on a national basis, and yet we're delivering record levels of profit. Our profit in the last half is up 40% year on year, and we see further upside as those listings start to return to normal. We're also seeing great growth in our marketplace businesses outside of our residential business. Good growth in our software as a service business, which we provide into agencies, and particularly strong growth in our enterprise business. This is data services, solutions, and artificial intelligence products that we actually sell into the banks and insurers across the country. And so overall, our goal is to actually grow our total share of the pie across all segments, whether that's consumers, whether that's agents, or whether that's enterprise customers across Australia.
Jason Pellegrino, thank you.
Thank you.